All right, hello everyone, and welcome to a new edition of what we're going to be doing with webinars with Pepperstone over the coming month. We've decided that we're going to change it over to this time of day because we think that it's going to make a little bit more sense in terms of what the market's doing for the week, and also it gives us an opportunity to actually isolate moves that are basically happening as we speak, and gives us an opportunity to potentially trade them throughout the week. So normally we're going to be joined by Thomas, but of course, he's away this week, so you've got me today, and we're going to explore the moves that are happening right now in some of the bigger indices and obviously some of the currencies as well. So we will jump straight in and start looking at some of the more popular analysis that people have been requesting. The first one we're going to have a look at is the S&P 500. Now, this one is going to make a lot of sense to a lot of people if you've been following our webinars for a little while, because it's doing all of the technical things that we wanted to do in terms of moves. And we're starting out really, we can see in the last session, even just in the last US close, that we've basically got a full engulfing candle, which was really a hold up of the big move down. You can see that we basically got down to the 6,200 or close enough to it. And look, and it's been a mix of news about tariffs and interest rate decisions that are or are not happening. There is a little bit of conjecture as to what is actually going on, but it is important to understand that we are actually right in the middle of earnings season as well. Okay, so there are some really, really important companies that have to report, and that is going to influence what we are seeing here on the indice, of course. So what we are looking for here is effectively a continuation of the long trend that we've been seeing. We've seen a series of higher highs and higher lows that have been very, very consistent over a quite a long period of time now. But we're also aware that we have hit an all-time high not that long ago. And we have to trade that with a little bit of trepidation, because we do know that, obviously there's still a lot of uncertainty in what's happening in the US. There's still a threat of potential war outbreaks, the consequences of the tariffs being implemented right through the economy has not really been realized yet. We've got job numbers that are a little bit on the nose, a little bit in terms of what the market wants to see. So when we're seeing all this bad information, or suspect information, if you like, out there, and the market's nearly at an all-time high, we have to be very, very careful that any really bad news might send it spiraling. Now, the way we see it, there could be two things that could happen here, very, very quickly and easily, and it's not going to surprise anybody. We're either going to see a series of lower highs and lower lows, which is a lightning bolt that we're always talking about, of course. And at that point, if we do see a series of lower highs and lower lows from this level here, and that's going to require a daily close below 6,200, that is really probably going to give us a move that we can count on down to around 6,000, which is another 200 points from that break zone. But what we do know about the 6,000 level is it's obviously a round number. We know that we've got a psychological level there that's really, really important. And we've also got a big level of support that and resistance, by the way, that is actually a role reversal zone. So that is a really, really strong target to aim for if we get that lightning bolt close. So what we want to see is that lightning bolt. But if the market starts to pick up momentum from this point, now it has reversed this entire candle. So although the move has been negative for a couple of days, a couple of trading days, what we are seeing here is an attempted break up from that level. And it's got itself back up above the 20 moving average, of course, which is a really important indicator for us. So if we do see a continuation of trend, and by that I mean we go to a smaller time frame, of course, and we look for, say, a 1 hour chart, and we'll auto correct that so we can see how it actually looks when the chart. Let me just zoom this out a little bit. You can see that we're already starting to get the higher low sequence here. If we start to see a break of that zone and we see a break to the upside from here, then we're going to look at long opportunities. If we go to the daily chart, why that's getting stuck there, we'll go to the daily chart again. Then we're going to look at a potential move all the way to the all-time high again, around that sort of 64.40 to 50 zone. Again, that's probably not my preferred move, and the reason that is because we're going into uncharted territory, obviously being an all-time high, with a lot of uncertainty in the markets. Now, earnings are going to have a fair bit to say about that over the next week or two, but also with news trickling out every day, and there's always something in the press about what is and isn't good about tariffs and interest rates that could push it higher. Now, what we do know for sure is that we've got a good sequence of higher highs and higher lows. We've got, if we do a fib retracement of the entire move. What you'll also see is the pullback that we can see right now is right on the 38.2 level. So we know that the 38.2 level is a very important zone in any market, especially one that is moving with quite a bit of momentum on the upside. So it has got a fair bit going for it, a good level of support. So there is a really strong opportunity that it might actually move up. I'm not biased either way. I think both of them make good technical sense, whether we go long to the all-time highs or whether we actually look short to move back down to 60,000. Either make technical sense. So we're pretty happy to explore both, really. So pretty good trading there on the S&P. We'll have a very quick look at the Russell as well, because it is a fairly important metric of the S&P 500 as well. So what we want to make sure we do is continue to follow this one, because it can be a little bit of a proxy sometimes of what is happening with the S&P 500. Now, what we see here is obviously a retracement as well. We can see the candle completely engulfed the previous one, but we have seen a little bit more weakness. Like this was actually weakening for nearly, or probably more, just a little bit more than a week from a 2280 zone, which we know is a very strong level of resistance. So given that is the case, that reversal is a little bit more important, and it's reversing off a level of roll reversal at that 2180. Now, the 2180 is a very important zone and it shouldn't be, it's not really a round number or anything like that, but it has proven to be an extraordinarily strong level, and there's been a lot of interaction around this level. When you go back, you've got to go back a little bit in time to understand it. But when you can see right through here, that we've got a lot of touches. There were spaces here for nearly 2 weeks straight where we were actually getting interactions and touches with this exact level, and it obviously bounced off from this level here and pushed up several times. Even when it broke through, you can see that it actually tested this level nearly every day until it actually broke through. Again, rejection there. So it's a very, very strong level to bounce from. If it was going to stop, this is the area that it was going to stop from. Whether it holds up or not is going to be the million-dollar question. If we see the 20 moving average holding up here and stopping price going any further, and we start to see a series of lower highs and lower lows, that could push us past the 2180 level on the Russell. And if it does that, we could be looking at a move back down all the way to 2100, which is going to see a significant downslide on the S&P 500 as well. While we're on the US indices, we'll quickly have a look at the NAS. And you'll see that the NAS is actually the complete carbon copy of the S&P 500. We've got a complete engulfing candle, a little bit off its all-time highs, but we're definitely watching this area with a lot of interest, because if we start to see a series of higher highs and higher lows, we've obviously got a very easy target to aim for, which is around that 23,700, which is, of course, an all-time high. However, if we see a bit of a rollover from here and all of a sudden we're trading underneath the 20 moving average, the next very serious zone for this is 22,000. And that is quite a bit away. That's 1,200 points away from, really where we are currently sitting at the moment. We wouldn't be getting in until around this level here, but there is a very strong opportunity to short it down to the 22,000-ish area if we see a series of lower highs and lower lows. It's very important to remember, though, that we are in the middle of obviously earnings season, so we have to be mindful that the market could shift very, very quickly if we start to see a sequence of dodgy reports, or even if they're a little bit soft, sometimes even in line can be seen as a negative, because the market's expecting a lot. And inline results sometimes can be have a negative effect on the market, and then we're going to start to see some bigger moves on these indices. But the move that we would be anticipating if we do start to go short is around the 22,000. That would be the level that we'd be aiming for on the NAS. We'll have a look at oil now, because it's one of the bigger movers that we've seen most recently. After we saw what was effectively what we call tariff gate, we can see that we hit a very strong level of support here around that sort of $66 to $65 a barrel mark. It had a good breakout just recently over the last few weeks, and we can see we moved up quite significantly to that sort of 71-ish dollar a barrel. Look, we can honestly, it's come all the way back down to the support level, and really, there are two ways of looking at this. We're either going to go down to the 60 relatively quickly, or we're going to go up to around that sort of 72. While it's trading inside this tight zone, and really, if we did mark up that 60, what you're going to see is effectively, if I'll pop a horizontal line there so you know what I'm talking about, we're effectively in the middle of this horizontal channel. Okay, so and there is very strong support there. You can see obviously clearly we've got very strong support right through here. It bounced off this level through here before it started to track up again. and we saw a very heavy consolidation zone of this level after the very big price shock. So realistically, it's at a level where you would expect it to stop after that attempted move up. What we're looking for now is a break of this zone. So if we start to see on the smaller time frames a series of higher highs and higher lows, we're going to start looking for, at the very least, a 71 move on the way up. That's what we'd be aiming for. And failing that, if we do get past that level, 72.50 is probably going to pull it up, because there is a lot of resistance at that point. We know that there's a fair bit of resistance right through that zone. If we see a daily close below the 65.80 or 65.50, then we're going to probably start tracking down to the 60, and we're going to look for smaller time frame changes of trend in terms of that to actually give it the momentum that it needs. Now, what we're looking for here, of course, is a series of higher highs and higher lows, or lower high and lower lows on those smaller time frames, like a 1 hour or a 15-minute chart if you're scalping it, and pullbacks to the trending moving average ideally. So I really like it when we see basically a level right in the middle of a very tight zone, because what it gives us the opportunity to do is actually trade towards a known level where the market's more than likely going to gravitate to if it picks up a bit of momentum. So if we see a break of the 65.80, for instance, more than likely what we're going to look for is a push down to the 60 with a fair bit of momentum. And that could come with 3 or 4 or 5 trading opportunities, depending on how the market's moving on the smaller time frames. And they're going to come in the form of pullbacks to a trending moving average. So they are really, really solid. We do like to see that. And ideally, in a perfect world, that would be our target. I wouldn't be looking for much lower than that, because I think that when we see a bit of a pull up at around a very strong support level, and we know that's been there for quite some time, it's generally a really good level to take profit. Now, one thing that some people do that you can get you caught out is actually doing a stop and reverse. And by that, I mean, you might start taking your profits at that level, but you automatically enter the reverse trade and think it's going to bounce up from there. You want to be really careful doing that, because it's not always a given that it's going to get to that level and completely reverse and actually get cracking up again. So just be mindful of that you don't really want to be always automatically assuming it's going to turn around. What you want to do is actually wait for it to actually turn around on the smaller time frames. So look for a bit of a sequence of higher highs and higher lows on a 15-minute and a 1 hour, and then you can start looking for the obvious target, which is going to be around that sort of 65 level. We talk about this a lot, and we've been talking about the same trading methods for a very, very long time. As you well know, a lot of you have been with us for a long time. The reason we follow these basic sequences of price is because we know they work. And when something works really, really clearly and definitively around, especially around areas of very heavy support and resistance, it's very easy to get into. And you can get into a lot of it during the sessions that you're more than likely ready to trade. So, if you reside in the Asian sector or the Australian markets, and you're looking for entry points throughout those sessions, you're generally going to get some sort of a decent pullback, same as the London sessions. And in the US sessions, if you actually, for anybody who is actually trading the US sessions, you're generally going to get a pullback in any of those markets, and you're able to take advantage of it. That's why the smaller time frames are so good, because they give you an opportunity to actually get in. But for the most part, we're in the middle of that channel now. Whichever way it breaks, we'd be looking at taking the momentum move down to either 60 or that 72 level. So pretty good trading there. All right, let's go over to gold. Gold has been a very, very important trade for a lot of people for a long time now. It's been going sideways for quite some time, as we know, but most recently it did test these lows. Look, it failed to make the equal high at around the sort of 34.50 marker, which was important, because at that point, what we're looking for really was a break to an all-time high. And a lot of people were calling it. Times of uncertainty sees gold generally thrive in that environment. So what we're really looking for is, especially if the indices start to get a little bit soft, when there's uncertainty, a safe haven like gold is generally where the market wants to be. So you can see that we had that little bit of a sell-off. It came fairly quickly at a level of resistance, and you can see that we pushed down pretty quickly down to a level of support. Why we love markets and technical analysis so much is because of the repetitive nature of what the markets do, right? So realistically, if this was going to stop anywhere, the level of support was going to be at around the sort of 3260 to 3270 marker. We know that we've had many touches over this period. We've got support and resistance there. If it's going to stop, that's the level it's going to stop. Now, if it did break through that level, and if you were shorting it, that's the level you're going to take profit, by the way. But if it did get past that level and pushed on down, really the next move is, probably closer to around that sort of 3,000, which is actually quite a significant move in the grand scheme of what gold has actually done. But right now, it's actually consolidating and it's starting to tighten, and really you can see the congestion zone has started to build. It's been a really strong move out of that support level. There's no question about that. And it's got a little bit more to go before it actually starts to find some real pressure. And that real pressure generally comes at that level at around that sort of 3,400. That's where the real resistance is. My feeling is that if we get a bit of momentum from this, and that uncertainty, throughout the next week or two continues, which is more than likely what's, part of the course around earnings season, we might actually see this breakout. And if it does test it again, the fifth touch is probably the one that may well break through. Now, how we trade that is the interesting conundrum that we face. Do we take profit at that all-time high, or do we look for a further move? Generally, the way we like to see it is we take that trade into two levels. First, we take a trade to that level, to the high that we're expecting, around that sort of 34.50 marker, and then we wait for it to actually break through and test it from above. That's the ideal trade, because what we really want to see, similar to what happened here, you can see that it breaks through, comes back and retests that zone, just like it did there, then off it goes. When you're looking at trades, that is always going to be the better trade, because you've got the proof of a retest of that zone. The market gets a chance to retest it. It gets a chance to look over the area, find a bit of a fair value, and then it makes a decision whether it's going to push off or it's going to continue down and effectively break that support and start moving down. The thing about the daily, and this is why we like the daily so much, is because it gives several markets a chance to actually consider that area. So the longer a daily chart like this is in an area, the better or the more stable the information is, because the markets, for one, have had a chance to consider it over a good period of time, and that's every market. So if we're talking about a daily candle, for instance, we're talking about 3 or 4 major markets around the world having a chance to consider that level and either leave it at that support or either break it or push on. What we're doing here is a decent push on. So for me, I would be looking for a trade, any pullbacks on a smaller time frame. So again, if you go to say a 15-minute chart or a 1-hour chart, well, that one's not going to be very pretty for us. Not sure why this is not expanding properly at the moment. Let me go to a 4-hour. You can see that we're already starting to get that cycle. We've already got a series of higher highs and higher lows. If we see a pullback, even back down to around the sort of 33.60 to 70 level, which is where a lot of these highs are, and then we get a new break up to a new zone, so basically we're getting another lightning bolt, that is going to give us the confidence to push up to that level. That's the pullback that I'm talking about, to actually get in on a trade and then effectively try and aim for the previous high. And then I would wait. I would let it break through and come back and retest that from above, because ideally that is the better trade. That's what we're really looking for in this instance. So really good trading on gold, I think, and I think it's a very interesting area. The next week or two is going to play a really, like I said, I really want to see earnings play out over the next 10 to 12 days, get the major ones out of the way. And then I think we're going to see some action in terms of where the indices are going. They're either going to go, retest the highs and push higher, or we're going to see a sell-off. What I don't think is going to happen is we're going to stay where we are. I think we're going to get a directional move one way or the other. It's just a matter of which one. My personal preference, again, like I say, is probably to the short side to give us a bit of a pullback. Then we can enter long with a little bit more confidence and a little bit more meaning. So at the moment, I think we need to see that. But gold is going to be the beneficiary of that either way, and uncertainty would probably help push towards a high. Now let's have a look at the dollar index. Dollar index is a very important metric, as you know. We talk about this a lot because this really defines what a lot of the important currency pairs that we talk about, being the euro and the Aussie, do. So really, as you can see, we've had a very, very big breakout move. We've had a good long series of higher highs and higher lows on the daily. It pushed to the 100 most recently, which is a very, very important level. It has come back now, but at this level here, we can see that we do have a level of very strong support. If we pop a horizontal line there, you can see that we've got, let me just pop this horizontal line. You can see that we've got a lot of support at this level. It basically touched it every day for about a month and a half. And you can see that really when we talk about that 98.80 as a support zone, the 20 is fast approaching it, as you can see. If we drew a pullback of that entire zone, we could draw a fib from the top to the bottom of that entire move, and you're probably going to find that's about a 38.2 level. And if you do a smaller fib of the most recent move, which is the impulse move, you're going to see a 50% fib retracement there. Now, why that's important is because it's at a level of support already, and also the 20 moving average is fast approaching it. So we're going to get 4 different ways of looking at support right there. We've got a roll reversal zone, we've got an important visual, we've got a higher high, higher low sequence, we've got a 50% fib on the impulse move, and we've got a 38.2 fib on the entire move from the bottom. So yeah, and look, let me draw it so you'll know what I'm talking about. If we draw it from top to bottom, oops, here we go. Let me just go from there. Get rid of that one. I'll just pop it in again. If we draw it from top to bottom, okay, you'll see that where the market is right now is around that 38.2 fib. If we draw another fib from the impulse move, which is around this level here, and went to the top again, you're going to see that crossover level, I'll just pop it over here so you can see it, is around the 50% mark. Okay, so when you look at it like that, you can see, let me just drag it out so you can see what I'm talking about, so you can see it clearly. You can see that the 50% mark is around exactly where price is right now. So that's a double crossover of fibs in the most recent price action, which is obviously a really important metric. And you've also got a 20 moving average to help bolster it up. So what that really essentially means from a trading standpoint is that if it's going to stop anywhere, this is the area that it's going to stop. If it fails to actually hold up here and starts to weaken, then this move is effectively over and we're going to start looking for shorting opportunities again. But if we do see a kickoff from this zone, we're going to look for potential moves way past the 120 zone and back up to around that 101.80 to 102 zone, which is a really big move. Now, that really impacts the euro, of course, because that's effectively the inverse of what we're looking at here. So really, a move on the euro down is imminent if we actually see these two play out. So this is why this is such an important zone. Now, whether you're going to trade this or not in this context, probably it's important to understand where this level is, because then when you go to the euro, you already know that we've had very, very strong support here. So if we go to the euro, which is one of the most obviously popular currency pairs that a lot of people trade, you're going to see that it's at very heavy resistance. You can see that we've had a big push down, the lower low, lower high sequence, as you can see, and a big push up to that 20 moving average, which is a really important zone. And we know that we've got a roll reversal at this level as well. So that's really, really important in terms of how the new market move is going to be. If that support holds on the dollar index and we see that big move up from that level, we're more than likely going to see a break of this 114 level on the euro and a push down all the way to around that 112, because that's what a 101.80 move would equal in the context of what the euro is doing. So that's why it's such an important metric to really consider. Even if you're not going to trade the dollar index per se, understanding where the dollar index is in terms of support and resistance is really important, because it gives you an important guide when you're having a look at something, especially the euro, which is effectively its inverse. So really, really important levels on that, and one to certainly keep a very, very close eye on. Bitcoin is the other one that a lot of people are wanting to trade at the moment. So let me just go down to Bitcoin and we'll have a quick look at that one as well, because this finds itself at a very important zone in terms of what it's doing. It obviously broke to an all-time high not that long ago. We can see that very clearly. It broke up and then came down all the way to a roll reversal zone. And the reason this level is obviously important, the 112,000 zone, you can see here that we've got, let's pop a line there. You can see that that was the point of resistance when it first hit before it actually sold off. Nearly got there again, and then it broke through good and proper. Had a very, very big consolidation zone. It was a falling wedge there for a while. Then it eventually broke through the support. And now it's retesting that support from above. So I'm going to pop another. I don't want to draw too many lines on the chart to confuse you, but I'm going to draw another line there because I want to really highlight. I'll bring it down a little bit. I want to highlight how many times this area was touched in this consolidation zone, because that's the area that is in danger of the move up. You can see it came down and hit the roll reversal zone. There's no worries about that. That was a pretty easy trade. Now it's effectively reversed off that zone, hit the 20 moving average, and trying to test the resistance from below it. If the 20 moving average holds and it does start to sequence down again, the obvious trade is going to be back down to 112,000, right? That's a pretty straightforward trade. But even in that instance, it is possible that we might find support there again, because this has been pretty strong support in the past. If that level gets broken, that's when we're going to be looking at a more significant move, potentially down to 109 in the first instance, but probably the bigger move may well be down to around that sort of 10, below these lows here. I'm talking about sort of 105 to 103 area, because this is where the next very heavy support and resistance is. This is a very, very important roll reversal at around this level. So that's what we're really kicking off on Bitcoin. I'm not really concerned which way it goes, because I think both of them are very viable trades from a standpoint of making technical sense. In my preference, I think I would probably prefer that it actually went down to these levels, and the reason I say that is because that's going to give us more opportunities to actually trade long from a very, very substantial base. Like if it goes long from here, there's not a lot of movement up to the all-time highs. Now, a lot of people are calling 150,000 on this by the end of the year. It may well happen. No one's going to stand in the way of Bitcoin, but the trades from good bases up to previous highs and then on and above are generally easier to trade, and they're going to give you better opportunities to actually get in and get more movement and more technical, I guess, levels hit and entered into. So you're going to get more opportunities to get in using technicals by it coming back first. The 2 steps forward, 1 step back approach has worked very, very well for a very long time, and it's going to be no different anytime you look at it. So ideally, I never really begrudge the market coming back to really strong zones like something around here, because then we're going to look for turnarounds, and at that point we can aim for the 112, we can aim for the 116, then we can aim for the 121. All of those levels that have already been hit are going to be easier to get to on the second iteration. So I think that's a really, really important thing for Bitcoin to actually achieve. So hopefully that makes sense, because I think that we've got opportunities on either side. Even if we do get a break above the 116, there is still some pretty good trading up to the 121 and above, but I wouldn't be looking much further past that from a scalping standpoint, because I think that's the easiest way to get into that sort of mindset of trading good levels, is trying to get to a level where you can achieve a high at around that sort of 121 in the most efficient manner, with technicals actually guiding you along the way. So really, really good trading on Bitcoin potential coming up, but this is a very, very important zone for it. What it does here, whether it tests the 20 moving average and pushes up and gets past that resistance, which is significant, or whether it rolls over here and starts to push down, both of them are very relative trades that you can scalp in on Bitcoin with a reasonable amount of confidence. So look, thanks everyone for joining us on this webinar. We're going to run this one every fortnight at around the same time. So in 2 weeks' time at around the same time, if you've registered, you're going to get your obviously your invites, and you're going to be able to watch the replays. But for anybody who hasn't registered and is watching this on replay, be sure to hit the registration link so you can actually get reminders of when this webinar is going to be on. Tom and I will be hosting these again. Like I said, we're going to talk about the relevant markets, and we're going to be talking about what is hot right about then. So by the time the next one is out, earnings season will be well and truly over. So I think we're going to get some definitive moves on the key indices that we've looked at today, and some of the commodities and currencies as well. So thank you very much for joining us today, and we look forward to seeing you at the next one.